Yo, what's up, everybody? It is Thursday, September 8th. How's everybody doing? So, we had another positive close today in the markets. Wasn't positive the whole day. I mean, we had Jay Powell come out and he made a statement or made a speech. By the way, before I get into that, let me just say that, yes, yesterday I made a mistake, because I was referring to Fed President, Cleveland Fed President Mester, and it is a she, not a he. It's Loretta Mester, and I kept using the pronoun he, and so I was wrong about that. But if you know me by now, I really don't care. Like, I couldn't care less about these Fed people. Really, I think they're ridiculous. So, I mean, yeah, I made a mistake. It's Loretta Mester. It's a she, not a he. All right. And actually, I did put a notation in the description of my video saying, you know, I messed up on that. But anyway, I just wanted to clarify. So, yeah, Powell came out today and, you know, he made the hawkish comments. You had to, right? Like, we're not going to let up. We're not going to let up. And so you know, the monetarist zombies were triggered and they sold the market and it dipped down, but it came back. But it was like kind of like zigzagging a couple of times today, but it closed up pretty strong. And I'm happy with where we are right now. I mean, we have a 91 billion deficit for the month of September so far through September 7th. That's good, because what's happening now, next week, of course, is going to be that quarterly corporate tax drain, 110, 120 billion. What's cool now is like we're filling up some extra water. It's like we're topping off the swimming pool, you know, in advance of that drain next week. So like, you know, we got a good level going because last month in August you had a 227 billion deficit. That's 227 billion added to the financial balances. Now we got another 90 billion on top of that. And by next week, you know, we could be like 110 billion. So it'll just come back down again, the level to where it was at the end of August. And then we have the whole second half of September for that level to rise back up again. So that's not so bad. And I may end up to be right with what I said. Remember when I said, I think in August, in the second half of August, that some of that selling, if not a lot of that selling, was related to front running ahead of that September 15th quarterly corporate tax payment, where, you know, companies maybe said, you know what, everything looks terrible and Powell wants to inflict pain. And so that means the market's going to go down because, right, that's the monetarist zombie mentality. And so they sold in advance of that. And I said, you know, we may not see a big decline on that drain next week. And if that doesn't happen, then that proves that I was right. So anyway, the monetarist insanity continues. You know, it's interesting though. I mean, because people just buy into this belief system. I mean, it may sound reasonable to them, but I think, like I've been saying, like it's been pounded so much into people's brains that they just accept it, and that's human nature. I mean, people tend to go with the crowd. It's hard to step out from the crowd. It's hard to be contrarian. I mean, you know, you got to have courage, and then sometimes you look foolish. And if you're with the crowd and you're wrong, it's very easy to say, hey, everybody else was doing it, so, you know, how can you blame me? Right? I used to get that all the time when I was a contributor on Fox News. When we do our business shows, you know, you'd have other guests, panelists or whatever, and I would talk about economics, you know, through the understanding of MMT. And it was like, you know, this was a classic, and maybe you've come across this kind of, you know, rebuttal, if you want to call it that, but it's not really. But when people say, if that's true, why doesn't everybody think that way? I mean, it's like ridiculous. Like if that was, you know, if that was an actual way of reasoning. I mean, we wouldn't have inventions. We wouldn't have, new innovation. I mean, it always takes new kinds of thinking or a different way to look at things or questioning. I mean, science is all about questioning, right? So anyway, yeah, people go along with that. Now today, again, I mean, I cite these examples every single day. Today, there was a headline. I saw an article that the bank profits are up 8% because of the increase in interest income. Now, I've been telling you guys this. First of all, I've been telling you that bank stocks are so cheap. I mean, I think every week I've been saying, look, bank stocks. And I absolutely have been citing the reason as interest income. How many times have I said, like, the Fed, I think I maybe even said it yesterday, that the Fed paying interest on reserves, like the Fed is in negative cash flow. Actually, I did say it yesterday, because now they're paying, they're going to be paying 3% on almost 6 trillion in reserves. It's 180 billion. They were paying 0 before March, or 0.05. I mean, effectively it was like 0, right? 0.05 is like 18 billion now. Now it's like 180 billion. So I mean, there it is. So now it comes out, like suddenly it was discovered. Man, I was telling you guys this stuff like for months ahead of time. I was saying, this is what is going to happen. This is what is going to happen. I also told you that QT, and I've been telling you that quantitative tightening, which everybody is afraid of. Oh, there's another thing. I sent that. Maybe I think I have this chart. I do, and I'm going to put it up right now. I forget what it was, but a record amount. What was it, like last week or something like that? You'll see it on the chart. 8 billion of put options were purchased. This is, and you're going to see how wild this is on the chart here. I mean, this is like not even on the chart. It's like practically off the charts. 8 billion of put options. Like, people are so insanely bearish. Like, I've been in this business over 40 years, and I have never ever seen this kind of psychology and this kind of sentiment, which is so negative. This blows everything away. This blows away the 2008, Lehman. I mean, there's no analog to this whatsoever. It's really amazing. I mean, I talk about how this monetarism has been taken to a level of psychosis. Like this is now extreme psychosis. This borders on, this is delusional. This is like, seeing things that aren't there. This is like, talking to yourself, like seeing things that aren't there. This is extreme psychosis. It really is. On the one hand, I think it's fascinating to watch, but on the other hand, like I said, it angers me, it gets me pissed off, it gets me mad, because I mean, I don't like to see all this ignorance, and worse, there's one thing about being ignorant, but I don't like to see this kind of crowd behavior, because it's very destabilizing, very destabilizing, and it's like I said, at an extreme level, extreme level. It's extreme psychosis. It's delusional. So this is what is happening right now, and juxtaposed to that is exactly what I just said, that you just see this big increase in profits at the banks because of interest, and that's because of rate hikes. And you might say, oh, Mike, well, okay, great, the banks are making more money. No, it's not the banks. Yesterday I talked about There's 24 trillion globally of US government securities held by people, by institutions, by pension funds, by governments, okay? And they're all going to get a big, gigantic fiscal boost, not just the banks. Now, again, maybe you don't own any, but there's other ways that, you know, the money flows into the swimming pool. All right? And it, again, I mean, repetition, man, that's how we learn. I got to repeat this stuff to you. I have to repeat this stuff to you. This is a major, major fiscal boost globally. And by the way, the ECB raised interest rate. There's two things I want to say about that. One, you probably already guess what I'm going to say. I mean, you know, the ECB, like all these central banks, they believe that raising rates fights inflation, right? When we have all these examples, you know, Turkey, Argentina, all these places where the more they raise, the higher the inflation goes up. And even the United States here, you know, Fed has raised 4 times. We still have high inflation. The UK, they've raised 4 or 5 times. They have high inflation. Canada has high inflation. So they keep doing the same thing, and now the ECB has jumped on board today for the ECB, what is a very, very aggressive 75 basis point rate hike. And so it's the same behavior over and over and over again. All right. But what I was saying, that's the first thing I was going to say. The second thing is that there is another example of a fiscal expansion, right? Because that's just going to add to the, you know, the flow, the fiscal flows, interest payments. And so it's a global phenomenon that's happening right now. And I think I said yesterday that it's going to take, you know, this is just the very early stage of this, stages of this, the very early stages. Because if you look at, for example, in the U.S. and the outstanding securities, you know, there's all different maturities. Like I said yesterday, you got, you know, T-bills, you got 2-year notes, 5-year notes, 7-year notes, 10-year notes, 30-year bonds. You know, as these things mature, the level is going to stay high. By level, I mean the amount of fiscal flow, the amount of interest paid to holders of those securities as new securities are issued with the higher coupon, with the higher interest payment. It means that those fiscal flows are going to stay elevated for a very long period of time. A very long period of time. So, you know, but you had Powell out there, oh, we can't back off. And I'm like, okay, you know, let us have more money. That's great. Let us have more. And I could see this in the data that I follow from the daily Treasury statement. I talked about this. I mean, we've already seen so far this year a 20 billion reversal in interest on Treasury securities, you know, paid into the economy. I mean, it was down. It was negative 17 billion, like in March, and now it's up. Or it was negative like 16 billion. Now it's up like 4 billion, and it's just getting started. So that's like a 20 billion swing positive of a net positive flow, and that doesn't even take into account the discount on T-bills. All right, I mentioned this in a prior video that T-bills, they don't have a coupon. They don't have an interest rate attached. They're sold at a discount, and that discount represents the interest rate on that bill. And that's like over a 30 billion increase that we've seen. So that's 50 billion right there. And it's just getting started. It's just getting started. And everybody is like, oh, you know, recession's coming. You know what's interesting? Turkey where the interest rate is 13%. Recently dropped down from 14%, which was a good thing. But still 13% interest in Turkey. The Turkish economy is growing 3 times fast. It's growing at 7.5%. That's 3 times faster than what we are forecasting now for the third quarter U.S. GDP growth. All right? I mean, we'd be lucky to grow at 7, and we grew at 7.5%, like what was it in the fourth quarter of 2021, and rates were 0. That's why I said rates are arbitrary. It's not about rates. It's about the growth or the lack of growth in the economy. If you made a case to me that rate hikes would crush the economy and it would shrink it, I would pay attention to that. I mean, I try to do this in a scientific way. And the economy went into 2 quarters of contraction. Yes, we just came out of 2 quarters of contraction. Why? Because, like I said, they slammed on the brakes fiscally. We were going 200 miles an hour until the 31st of December 2021, and then bam, they slammed on the brakes and cut 1.7 trillion of spending flows. Net 1.7 trillion of spending flows. So yeah, you go from 200 miles an hour down to like 0, down to negative. We went backwards. But now the flows are stabilizing again. It wasn't about the rates. Since the rates have been increased, we're starting to see an improvement now in the economy, because that is adding to those flows. What else? There's one other thing I want to mention. The EIA weekly petroleum status report was out today. Now, something interesting. We have seen the 3rd week in a row of a drop in petroleum exports. Now, I've been saying that the thing that has been underpinning the dollar strength has been the fact that U.S. petroleum exports are just setting records. Now that Russia, the sanctions and everything, U.S. has become a major global supplier of petroleum, crude and refined products. We are a net exporter. But Biden, I think it was last week or 2 weeks ago, he said he made a plea to U.S. refiners and oil producers saying, please, can you cut back on the exports? We're going to need, that supply here. And it looks like they're listening to what he said, because I've seen now 3 weeks, and this past week that just ended, it was a big drop, okay? So that might be a cue to a correction in the dollar. I know many of you have been asking me, what do I think about the dollar and and I keep saying, look, as long as the U.S. remains a net exporter of oil, the dollar's going to go up. But now that we're seeing this pullback, and it's probably going to be temporary, but it could last, through the end of the year, maybe it might even last into the spring of next year. I don't know. We'll see. And maybe it won't even last at all. Maybe next week, boom, the exports will be right back up again. Maybe U.S. producers will say, screw this, we're going back, we're exporting. But I'm just saying, like, the risk reward right now to make go short on the dollar, I think it looks pretty good to take a shot on that as a trade. I'm not saying now that's over, the rally's over, it's going to crash down and that's the end of the dollar rally. But the fact that we've seen 3 weeks in a row of a reduction in U.S. petroleum exports, and this past week was a big drop, okay? That's meaningful to me. So take that into consideration. All right, folks, that's it for today. Hope everybody had a great day. See you tomorrow. Bye.